On this episode of our latest Founder Series, I sit down with Brian Harstine, CEO of Acquire. It's funny, when I started King's Crowd over 6 years ago, the idea of even managing a capital raise online was really foreign to founders and investors. But now we find ourselves in a place all these years later, thanks to a mix of investor awareness, new regulations, and a growing base of founders leveraging digital tools to better enable their raises, then investors are coming to actually expect a digital-first investing experience. And that is where Acquire comes in. Acquire takes all the pieces of closing a round in the digital realm and streamlines it into one solution, from data rooms to closing docs and money transfers. If you're thinking about running a capital raise for your company that isn't a CF or A+ round, but you still want it to be a digital experience, listen in to learn how Acquire can help. For those who don't know you, tell us a little bit about your firm and how you came to found it and why you founded it.
Yeah, that's a long story. I'll keep it short for everybody here. We founded Acquire Invest because we were solving problems that I was having. I was working in private equity at the time and doing a lot of back office, middle office functions and communicating to the front office. And there's just a ton of disconnected, data, disconnected processes, people that you're just tracking down left and right. And most of the solutions that I found in the market today, they were very manual. And there's very good ones out there. They get the job done, and a lot of fund administrators even use some of those. But it just had to be a better way. And I don't know. I say that my analogy is I was lazy, right? So I wanted to build something that would do it for me. So here we are building a very, very complex, institutional grade system for asset managers, fund managers, issuers, for private market and alternative investments to automate a lot of those functions, connect all those departments and all those teams, and create a single source of truth, truly, across the general ledger.
So let's talk a little bit about the complexities you found in being in kind of traditional private equity, where you found some of those key pain points. And then, we talk with tons of issuers at Raise Papers. So let's dive in a little bit on how issuers can work with you to simplify their fundraising process.
Yeah, that's a great question. So, it depends on who we're talking to. Like, who's listening to this today? Are you on the front office? Are you dealing with investor relations and trying to onboard and close guys? Or are you kind of in the middle and back office dealing with, I've got to get reporting done or tax docs to people on time and maintain data sets and transaction records and void documents and reissue documents, KYB, are you compliance, right? Is the compliance element. So really interesting element of what we've done is actually improve things across the chain for each of these departments. Because you talk to someone in compliance, they're going to tell you their problems are the most important, and they're going to tell you their problems are very different than that of the guys in the front office that are like, man, I just want to onboard this guy. I got him to commit to $1 million today. Like, can we just get him done? It's taken 2 weeks to get this guy onboarded. Why? Right? So, I found that was the problem, is each of them had problems, and it's partially because they weren't connected. So making these small improvements to many of these functions, call it 1,000 improvements to 1,000 different places, made everybody's life a lot easier. So, I think a short, like, end-to-end description would be, we can help you handle KYB, KYC, accreditation, document signing, subscription document signing, all within the platform, data room management, all within the platform. And these are not connections to some third-party source, aside from our KYB functions, KYC functions. These are functions internal, so we don't use DocuSign. We're not using like a Dropbox integration. These are things that are inside and secure within the platform. Messaging systems are within the platform between you and your investors, that investor relationship. Updating everything in the cap table or the general ledger happens pretty automatically. I mean, what we've actually done is connect transaction systems into the system itself. So as you're onboarding, you complete all those functions, you can actually attach a funding source, send your money via wire, via Plaid, ACH, and it'll automatically update and settle within both the issuer platform and the investor platform. So after that, it's just a suite of tools to help you with data intelligence, ongoing reporting, and so on and so forth.
Got it. So now, when you're working with issuers and they're coming to you, they're essentially taking what is traditionally their offline process, if they're doing a Reg D, and now they're running the full process through you guys. From a cost perspective, is there cost savings? Is there an additional cost to this? But it makes your life so much easier, kind of who cares type of thing. What does it look like from a cost perspective for founders? And how do you think about that in terms of kind of the overall streamlining and efficiency?
Yeah, we've done some cost analysis on a couple of different platforms, as well as probably what we see at both the entry level, middle market, and institutional level. And each one of those levels are going to find different value in the platform. They're going to find different cost efficiencies with the platform. But the interesting part is all of them still have to comply with regulation, right? They all have to kind of do the same thing, just maybe in a grander fashion than the next one. So in comparison to other platforms, we are very easy to understand in terms of cost. We're not going AUM based. We're not hiding a bunch of fees left and right. It's very simple the way that we charge because, again, I've been on the other side. I've had to figure out what my cost basis for my fund is going to be. We're collecting 2% management fee and we got to use that to pay for a bunch of stuff, right? So how do we make this simple for you guys, but also cost effective? We actually have put together a couple of plans for entry-level SPVs. So SPVs under $1 million, SPVs $1 million to $5 million, and then we have our fund plans, which are for pretty much anybody else at any price point. So we're not going to take an AUM on a $1 billion fund when there's another guy over there using the same plan for the same price as the $1 billion fund, but he's paying this. It's you can go to the website right now. It's like $8,000.
Got it.
Pretty
so
cheap.
In terms of investor onboarding, I know that that's a complexity that many founders have found, even in working with platforms in the Reg CF and Reg A plus space, right? There could end up being a lot of information that needs to be shared before that investor can make their investment. And it could bother people like, oh my God, you're asking for all this information. It's preventing them from creating the account and just making the investment. How much of that can be streamlined, especially under Reg D? Is there less information needed? And how much of it truly is just like, listen, the KYC, the know your customer information that's required is just a certain level by the United States government, and there's not a lot you can do about it?
Yeah, I mean, it's required. At the end of the day, if you want to do it now or later or put yourself in a potential risky position by not doing it, that's up to you, I guess. But where we sit is you're going to have to do it. You're going to hire your lawyers. You're going to hire a fund admin, or you're going to go off and use a platform to try to do those functions yourself. And you're probably going to end up with 6, 7, 8 platforms when you have to do all these functions individually. You start a fund, you go to your lawyers and they say, here's your docs. You start raising money and then you forget you got to do 50 things. So typically, by the time you're through your first fund, you're on your second, third, fourth fund, the problems, you've experienced them. You're going to be begging for something that's simple, right?
Right.
Like, I've been there. So.
Now, you talk a lot about funds, so obviously individual issuers can come, set up an SPV, manage their fundraise for their business, but it also sounds like you'll do kind of full fund administration as well. Is that correct?
So we're not competing with fund administrators. We really see this tool as a way for fund administrators to scale. They can actually utilize this platform. They can license it from us, include it in their services, or resell it to their customers. We see it as a way for them to really just become more efficient. They can service more clients at a higher quality with modern tools, probably increasing everybody's enjoyment of the experience, customer satisfaction. So that's kind of where we sit. Now, we will probably disintermediate some of the functions that they may charge for, but I think that most fund admins are saying that those are that's busy work. That's stuff that
Right.
is kind of cost of doing business, table stakes, not necessarily things that they consider their core value add to the end client. Those things might be around helping them, and we do capital calls too, but helping them really structure the capital calls, make sure it's set up correctly, because just because a fund manager says, I can do capital calls with your system does not mean that they can set it up correctly, right? So we do have a system that can run capital calls. It can help you with, pro rata and waterfalls, things like that. So, if you were, say, maybe a former fund admin or have been in the industry a long time, and you can set up a bunch of this stuff yourself, you might not really need a fund admin as much. But I think that's a pretty rare person.
Something that's kind of interesting that I've learned over many years of raising capital in many different ways is that payment processing actually can have a lot of complexity and a lot of issues that come with that. When founders are utilizing your platform to fund their deals, is it just traditional wire and they're still kind of accepting stuff offline, or do you have payment infrastructure in place to support everything from ACH, potentially credit cards, so on and so forth?
Yeah, so we've got a couple ways for the issuer to link in a destination account. We also have our own escrow services that are built into the platform. So it helps us automatically settle transactions, which brings me to your question. The transaction platform that we have, it does integrate with Plaid. We do have wire systems where we can, automatically track and settle those wires. Basically, you originate the wire from the account or from your account within our system, and then you might go to your bank and finish that at the bank. In which case, we've actually we're starting a monitoring system on the back end to recognize the transaction and settle it automatically. And then there's, of course, the escrow team does their job to work on that, diligence every transaction, so on and so forth. We are working on a Fed 1031 drawdown, 1032, which will simplify that wire process for our, end LPs, those end investors of our clients. It will simplify them in the way that you can say, I would like to wire money and I don't want to call my bank. So essentially, we have a bank call another bank and they do the job for you.
Nice.
More or less what it is.
I've certainly run into that. Yeah, there are investors who, I kind of say we're in this transitionary period in the world where, the online and offline world, they're converging, but there's still those people who don't want to go online and, they want to stay off. So we're still dealing with that investor base that kind of hasn't evolved forward to where we are today.
Yeah.
Just take a step back for 1 second to help founders realize, especially kind of first time or younger founders who haven't gone through a capital raising process all that often at least. All of the pieces that are involved in actually getting a capital raise off. So, things that come to mind, right? Everything from your legal, your subscription agreements, and all of your kind of legal docs. Data room, right? That's where they're going to want your financials shared, where they're going to want the deck, where they're going to want who owns what of the company on your cap table, so on and so forth, all the typical information they ask for. And then there's actually signing the docs and then wiring the money. Escrow agents, like what the heck is an escrow agent, right? There's all these pieces. There's a lot of checklist items you have to have in place before you can raise capital. Can you just go over some of those key elements and maybe some of the biggest things that like people don't realize going in, like an escrow agent? We're like, wait a second, why do I need that?
Yeah, that's a great question. It depends. Some people do need an escrow agent if you're a startup founder. We're talking about founders now, less so funds. So if you're building a company, everything Chris said is necessary at some point or another. Escrow agent might be optional. You may not need to put the money in escrow, but that depends on how you've structured your raise, right? So your raise might be structured where if we raise $10 million, then we break escrow and we can access that money. Or it might have other rule sets on it where it says, if we raise 8 million of 10 million, then we can break escrow. But we have to hit a threshold on our raise in order to justify taking that capital out of escrow. If not, if we don't meet those rules as a company, we didn't raise enough money to build the product we say we're going to build, right? Or build the company we say we're going to build, then the money sits in escrow, possibly even is returned back to those investors. So those structures put the pressure on the founder to really perform when you're raising money, but it also gives your investors a little bit of security, saying, okay, well, at least I know that I'm not just giving you money and you're going to get enough to accomplish the task at hand, right?
Yep. No, that makes a lot of sense. And so basically it's a third party account that's holding the funds and saying, you can't have them yet. Wait until you actually hit a certain threshold before we're going to give that to you. Um,
Yeah.
in your experience, having gone through fundraising processes before, I don't know if it's whether it's an hours basis or just a pain basis that you could talk about, but how much the system that you've built is saving a founder from the typical fundraising process that they would typically deal with.
Yeah, I mean, we've built tools well beyond, as we mentioned, funds and institutions, asset managers. A lot of these functions will be irrelevant to, an individual company raising money. Now, when you are a company raising money and you do want to make sure that you are taking money from the right people, you may need to do a KYC check, you may want to do accreditation checks. Your lawyers might do that, they might charge you for it. You're probably not using a fund administrator who's going to help you with all those compliance elements. So, if you're worried about making the wrong move, this helps you maintain that within a system that can say, okay, you're in compliance, right? When you're sending out DocuSigns to 24 people and, everybody's got maybe a slightly different term sheet, this can help you actually set those up and send those out. Or if you're sending out the same doc to 24 people, they just log in, they go through the process themselves, which is KYC, AML accreditation. It builds their portal for them. When they get ready to transfer the money and sign the agreements, they're already sitting there waiting for them. So it's sort of like, checking out with, Shopify?
Right.
But instead of buying, a t-shirt, you're investing in a company.
Now, you did talk about kind of the other side of things, asset managers and whatnot. I think both you and I are both kind of believers in alts going mainstream, right? And more people starting to invest in alts at the institutional level. And I think you're another piece of that equation. So hitting on that side, I'd love to understand a little bit more about what you're building for asset managers and the type of behavior you're seeing from them based on having these types of tools available to them.
Yeah, I mean, you can read articles left and right. It's not us wanting it to happen. I mean, Blackstone, BlackRock, for example, have numerous articles out every year where they're talking about their down market participant programs, what they're doing to bring great products that are typically reserved for very wealthy people to, people at smaller check sizes, right? Still probably accredited when you're talking about asset managers at that level. But some are even moving, maybe not Blackstone, but some are even moving down market even further, bringing retail investors into the same type of private assets, alternative assets that you see the ultra high net worth people investing in. They're typically not as correlated with markets, so the type of asset class has appeal. The return ratio is typically a shorter time period than what you would want to see when you're putting money into a stock market like an S&P 500 and waiting 30 years to get your, average of 8% per year, right? Or however long it takes to get your average of 8%. So, it's an attractive asset class. I think crypto has really opened people's minds to the idea that there are other ways to invest, right? Other things that I can make money on. And then they start realizing, oh, there's these other platforms out there that give me access to real estate, that give me access to debt funds and so on and so forth. So, what I realized pretty early on is that all these great venture capital firms, these great private equity firms that are out there that are sitting with incredible assets, really smart fund managers, that are making these investment decisions, their reason for not really going to this down market smaller check size is quantity and cost. And what we do is essentially speed that up, make it more efficient to scale to a larger quantity of investors at potentially smaller check sizes, but that's up to them, right? So we've built it really for the institutional mindset, but we built it for scale. So at the institutional level, when they don't care about going down market as much, they just want bigger checks, fewer investors, they're looking for things that are going to save them money on efficiency of operations. And that's what we do. But at the bottom level, when you think about people that are dealing with a couple hundred investors in a VC fund, that's a pain in the butt, right? To raise 20, 50, $100 million into a VC fund. sometimes they are forced to take smaller checks and increase the number of investors, which increases the work, which increases the amount of people you need inside of the fund, which increases your cost basis, which removes the money from the table for the returns for those investors, right? Because it's comes right out of the money they invest. So the idea of saving money on operations is really the end of the game for us. It's like automation, connectivity, that really enables this, but it also does enable products to form in the market for different participants on top of that. That's kind of a cherry on top, as it were.
And are you seeing more, because I think this is exciting for founders as well, are you seeing more asset managers want to provide exposure to both individual deals as well as kind of venture funds and things of that nature? Like, are more and more coming to your platform saying, hey, we need to start offering this to our clients?
Oh, yeah. Yeah. SPVs have exploded. I think the amount of angel groups out there that are putting together, one-off deals for companies have exploded. That people can use our platform for things like that. To the point where they're having a hard time making a decision on which platform can help them do this, because most of the people putting together those type of pooled investment vehicles, they don't do it for a living. It's not they're not asset managers, they're not fund managers. They're smart people, but it's a full-time job. So they turn to platforms to try to help them speed up that process. And you've got your angel lists out there that kind of made their mark on that early in the game. But now you're seeing things where you want people to have a little bit more control. They see a path forward. They may have a series of SPVs that they have planned, which one of our clients right now has, I think, 15 SPVs planned, and that's all they do is just series of SPVs. Small, targeted, very intricate, deals for select investors. So they've got a large group, and those people get in and out of different deals as they want. With our platform, it gives them the ability to show 15 plus deals or 30 or whatever to that set of investors and give them that optionality. And we've seen that with a couple of different, not just angel groups, but these investment communities that are evolving. They're evolving not just around SPVs, but Regulation A+ offerings as well.
I'm curious for founders, issuers, funds, all those types of folks who are listening in. Where should they go? What should they do if they're interested in working with you and learning more?
Acquireinvest.com.
Awesome.
Yeah.
Well, you heard it here first.
Yeah. We actually, the book now button, book a demo, that goes directly to me. So you're probably going to get me or one of our co-founders on those calls, directly. You're not going to have to deal with, 2 or 3 random people to get up to talking to us. So
love it. Well, Brian, thank you so much for your time. Thanks for your insights. It's been incredibly valuable, and really excited to see the platform continue to grow. And for issuers, I highly, highly recommend you go check it out. I can attest to the fact that running any of these capital raises can be incredibly complex. If you're doing a Reg D, 506B, or 506C, I think this is a really phenomenal option and a step in that right direction of digitalizing the private market transaction process in a way that actually makes sense. So thank you again, Brian, for what you're building, and have a wonderful day.